Good afternoon, everybody, and welcome to the BlueKey Market Review / Outlook for April of 2017. This is Bruce Connors. So today, as we have done in the past, we're going to take a look back at the previous quarter, then look at the U.S. economy and the global economy, take a look at some of the risks, technical look at the market, we'll review the valuation of U.S. markets and overseas, and then wrap it all up. So in the first quarter, it was another solid quarter. The S&P returned 5.53%. That's without dividends. And if you held the S&P from beginning to end, you gained 6.03% with dividends. The big news really was Trump's inauguration, which was on January 20th. It's number 3 on this chart. There was a lot of talk that the market would sell off after the inauguration, but that didn't happen. In fact, the market rallied for a while in anticipation of the Trump pro-business agenda. It's tailed off in the last few weeks as it's become kind of obvious. The agenda is not going to go through as quickly as people had hoped. And then also there's some geopolitical events going on around the world. Let's look at returns by style box. So in the first quarter, pretty much everything was up. Everything was in the green. But it was the growth category that was the big winner. And I'm looking at the chart, the table off to the left. Large cap growth plus 10.24%. Going into the quarter, most investors thought that value, which had been the big winner in the previous quarter, would continue, but that didn't happen. Growth came back, and as it has in the past, became the leader for the first quarter. Looking at sector returns now, technology plus 10.8%, that was the winner, and the loser was energy minus 6.53%. Looking at international equities, down toward the bottom, emerging markets plus 11.76%. And you might recall from our webinar in January, we had spoken that there had been so much underperformance over the last 5 years overseas, internationally, in both developed markets and emerging markets, that was bound to rebound at some point. And at least so far in the first quarter, that proved to be the case. Looking by country, pretty much everything was in the green. Chile, China, Hong Kong, Turkey, the big winners. Russia was in the red, minus 10.6%, as well as Greece. Here we're looking at fixed income categories, and emerging market debt denominated in local currency in U.S. dollars were the winners. Mortgage-backed securities just came in at plus 0.5% towards the bottom. And of course, there's worries about that as the Fed begins to unwind its balance sheet at some future point, probably towards the end of this year, maybe next year. That would probably keep MBS investments towards the bottom of returns. And here we're looking at commodities, and in 2017, all the way off to the right, you'll see silver and cotton were the winners. Here we're looking at broad asset classes. Emerging market equity and developed market equity were on top. Here's a look at the composite index of leading indicators, and for February, pretty much everything was in the green, which would be a good sign going forward for the U.S. economy. Here we're looking at the yield curve, and it is not inverted. That would be a positive sign. When you get an inverted yield curve, that's often a sign of a recession that's fast approaching. Off to the right, you see a probability of a U.S. recession predicted by the Treasury spread. This is calculated by the New York Fed, and they only have that chance over the next 12 months at 5.2%. Here are jobless claims. They continue to be low. In fact, they're close to lows dating back to 1973 in terms of absolute numbers. They're not increasing. The job market continues to be tight, so that's another good sign. This is the Atlanta Fed's GDP now. They calculate what they think growth is going to be, and here we're looking at the first quarter of 2017. This chart really doesn't look that good. If you look at the beginning of the quarter, and we're looking at the green line, the quarter began and they were calculating growth of around 3% or so, but it's tailed off almost every week as the quarters progressed. However, there might be something seasonal going on here. If you look at the graph from 1 year prior, you'll see a very, very similar pattern. And then what happened as the year rolled on, growth picked up. The New York Fed's nowcast also takes a calculation, and this one is not as dire. It forecasts first quarter growth at 2.6%. We'll have to wait to see what the real number actually is. And here are some other estimates for Q1 growth, ranging from the blue chip consensus 1.9%, macroeconomic advisors 0.9%. You take the average of all these, it's around 1.75%. So basically, it looks like growth in the first quarter is going to continue on the slow and steady path that's been the case for the last several years. Here's a look at Q2, the New York Fed's nowcast. They have it at 2.1%. That's early on in this quarter. This is a BlackRock model, which forecasts growth looking about 3 months out. And you can see they're positive. They're forecasting increasing growth. And here's the same model, and this is looking at the G7 economies, and again, improving growth. This is the Global Purchasing Managers Index from around the world, and it has improved. So the most recent reading is 53.8. Anything above 50 is considered expansion. Less than 50 is contractionary. So right now it's 53.8. When we did the last webinar, it was 53.4. And when we did our webinar in October, 51.7. So economies around the world seem to be improving. And there's a heat map of the same thing. And off to the right is March of 2017. And the greener you get, that means more and more growth. And you can see how this heat map has gotten more and more green as time has gone on and as you move to the right. Leading economic indicators around the world are improving. China is in green. You could see it's moving up. The G7 economies are in blue. You can see it's moving up. We already went over the United States. Corporate profits are also improving, and that's a lot of the engine behind the rally over the last several months, especially overseas and in emerging markets. Market risks, to me, and I've been talking about this for like a year and a half now, the anti-growth camp of the Trump administration. If they went out over the pro-growth camp, that would be negative for economies around the world and for the United States. Political risks. This seems to be receding a little bit, but if the populists win in certain elections in Europe and put the Eurozone in danger, that would be a negative. Geopolitical risk. You can't really measure when this is going to pop up, and this could turn out to be something major or probably nothing at all, but potential problems with North Korea, Syria, Russia, terrorism, etc. Market volatility has been very, very, very subdued, except it just started picking up in the last few days. But at some point, volatility is going to break out again, and the market may not like that. Oil, we're going to go over oil in a couple of minutes. China is always a risk, although it seems to have been improving over the last few months. So here we have a chart of the price of oil, and off to the right you see the different predictions of where oil is going to trade by the different investment banks. Oil right now is at about $51, $52 per barrel. The risk is that if oil collapses again like it did last year, that helped lead to the big sell-off in January, February last year. So if oil can stay steady or improve a little bit in price, that would probably be positive overall for the markets, and that seems to be what the investment banks are forecasting. There's an OPEC meeting in May, which will have a lot to do with what happens to the pricing. Retail has been in the news a lot, and this is one of those areas that might have some unintended or unanticipated consequences. But basically, bricks and mortar retail has been really hurt. You can see off to the right all the recent bankruptcies or close to bankruptcies in retail. So stores are really closing at a record pace. A lot of the B and C malls are going to be at risk. And it's forcing, the whole e-commerce thing is changing the way malls look. So you're starting to see newer brands and online brands go into some of the malls. You're seeing more food in malls, like grocery stores. You'll see now a Planet Fitness or some kind of other gym like LA Fitness, doctors' offices, more restaurants. And then in some cases, they're having to turn parts of the mall into office space or take empty parking lots and build apartments or hotels. So people that own all these malls are going to have to start being really, really creative to keep their properties values up. This is a look at employment in the retail sector. And the red line is internet-sensitive stores, in other words, brick-and-mortar kind of stores. And you can see how employment, this is a percentage change year over year, is going down. The blue line would represent e-commerce retailers, and it's moving up. The problem is there are way more people working in brick and mortar stores and a lot less people working in e-commerce stores. So even though on this graph it appears that the blue line is offsetting the red line, in absolute numbers it's not. People are losing a lot more jobs in retail. So the main thing we're trying to get across here is that we have to keep an eye on the retail sector and see if there are any unanticipated consequences down the road from the decline of retail. Auto inventory and subprime loans, this is another area you just got to keep an eye on. Auto inventories are up compared to sales, really at the highest level since like 2009 or so. There's been a lot of easy credit. A lot of subprime borrowers got loans over the last year. And if you look on the right, you could see that is now coming back to sting some of the people that lent to those subprime borrowers, because the Q2 loans are already beginning to default at a faster rate than loans prior to that. So after the election, we had this big Trump rally, and investors got excited on Trump's pro-business agenda, concentrating on deregulation, tax reform, repatriation, and an infrastructure program. Well, we've begun to get some deregulation, or at a minimum, we're not getting more regulation, which is a positive. But the other three factors, tax reform, repatriation, infrastructure, that's not going to happen so quick. That's going to be somewhere down the line. So this all led to what was called the reflation trade. But now the reflation trade, at least for today, is kind of off the table, and the market has slowed down and even started going down a little bit over the last couple of weeks. The good news, though, is that Trump has backed off his protectionist agenda. At least he doesn't appear to be going after it in a major way, so we view that as a positive. Here's a look at the S&P 500, and you can see on March 1st we hit the peak of about 2,400 on the S&P. We've been down a little bit since then. So you look at 1, 2, and 3 off to the right, you see a series of lower highs. And then 4 and 5, you see a couple of lower lows. We're going to have to see what happens this week. Right now, futures are down and today is Sunday, going into the market tomorrow. So there's a chance that we're seeing the beginning of a correction, which we have been kind of anticipating for a while now. And here's our correction chart of pullbacks of 5% or more. We're way overdue for a correction. And of course, corrections are a normal part of market activity. So as of April 14th, it's been 291 days since the end of the last pullback, which is a very long time. And in fact, it's the longest on this chart, which goes back to 2005. Now, let's assume that we're in the midst of what will be a 5% or more correction that started on March 1st. Right now, we're down 2.8%. Well, that would mean that there was a 247-day gap between this correction and the last one, which would kind of make sense. The previous high was 252 days, and that was back in 2007. So it would make sense for a lot of reasons that we are in the midst of what will be some kind of correction. Here you look at intra-year declines in the past, and you'll see, the market just goes down every year, at least a little bit. It's just part of normal market activity. So it wouldn't surprise us to see a pullback of somewhere in the 5 to 10% range. Let's start talking about valuation and earnings. So for 2017, the market is anticipating almost a 10% increase in earnings, and for 2018, an even bigger increase of 13%. So as of today, the S&P 500, the price was $2,328.95. Earnings estimates for the next 12 months are 133.84. So that calculates out to a forward PE of 17.4. So as you see on this graph, 17.4 is way above historical averages. Now, one of the things pushing the market to these more aggressive PE ratios is the fact that we still have very low interest rates. We'll show you a chart in a couple of slides. And then you have increasing earnings in the United States, which are finally picking up. You have increasing earnings around the globe. and then you're hoping to get a tailwind with the Trump agenda. So those are some of the things that have pushed up the PE ratio. So let's figure out what would be the price tomorrow if the S&P fell to its 5-year average. In that case, the price would be 2020, which was, we last saw that price in June of 2016. And if it went down to its 10-year average, the S&P would drop to 1873. We're not forecasting that, but we just wanted everyone to get an idea of what the price would be if the market fell back, and assuming the forward earnings remained at this level. This chart looks at the Morningstar median fair value. So we're looking here at stocks that Morningstar rates, the median stock, and comparing the price to the fair value calculation by Morningstar. It comes in at 1.02, which is just above fair value of 1.00. This actually declined from the last webinar we did in January when it was at 1.03. So you can see it's just a little bit over fair value, but it's not wildly overvalued. Here is the 10-year Treasury. It closed on Friday, or Thursday actually, at 2.23%. It's declined over the last couple of weeks. Let's look at some valuation measures. So price to earnings, on this particular chart, it's at 17.5. Earlier on, we said it was at 17.4, but about the same. The 25-year average is 15.9. The CAPE ratio, that's the cyclically adjusted price earnings ratio, is at 29. The 25-year average is 26.1. And price to cash flow is at 12.2 compared to a 10.6 25-year average. So based on those metrics, the market is overvalued, but it's not wildly overvalued. It's all within a standard deviation of the 25-year average. So I would say the market's fully valued, but not wildly overvalued. Now, if you look at the earnings yield spread, that's EY spread. That's the earnings yield. You're taking the earnings divided by the price and then subtracting the yield on a BAA corporate bond. And you'll see that the earnings yield is greater than the BAA bond. So this would be a reason why the market is undervalued, and we've spoken about this, in the past. Interest rates are so low that it's justifying higher ratios, higher values in the equity markets. Now let's look around the world where there might be some better values. So here the blue diamond is the current price to book ratio, and the light blue square is the 10-year average of price to book. So you'll see the S&P 500 is overvalued based on this metric, as well as the Russell 2000. But if you look at the emerging market index, the Japan index, and the EAFE index, and these are all measures of developed markets overseas, as well as emerging markets and Japan, you'll see they're pretty much in line. They're not that overvalued. They're roughly at their 10-year average. So right now you might be able to get better values in selected markets around the world. So in this chart, we're trying to take a look and come up with some calculations as to what the market might return over the next 5 years. We're assuming in all of these tables that earnings grow and dividends grow at a rate of 5.47%. And where we're getting that number, that's the geometric return of the market since 1997. So in the top set of numbers, we're assuming earnings and dividends grow at 5.47%, and that's the case in all the numbers on this page. And the PE ratio stays the same at 17.4. So under such a scenario, the internal rate of return over the next 5 years would be about 7.37%. But I don't know how practical it is that the PE ratio is going to stay at this level. If interest rates, slowly rise, at some point the PE ratio is going to start to contract. So let's assume that the PE ratio drops to 15.1, which is the 5-year average, and now we're in the middle section of this spreadsheet. And in that case, the internal rate of return over the next 5 years, and this does include dividends, would be 4.53%. And on the very bottom, we're assuming that the PE ratio declines to its 10-year average, which is 14. In that case, the internal rate of return would be 3.05. So taking some really, really broad assumptions, you could make a case that it would be reasonable to assume that you would get returns in the U.S. equity markets of somewhere between 3% and 7%. So pick the difference and you'd be, roughly at 5%. Coincidentally, that pretty much corresponds to this chart right here. So here we're looking at a forward PE and the subsequent 5-year annualized returns. So here the forward PE is 17.5, and if you go out all the way to the left, that's pretty much 5%. So equity markets in the US, and of course there are no guarantees, but roughly speaking, it would be reasonable to assume that you would get a return of somewhere around 5% over the next 5 to 10 years. And a lot of that has to do with the elevated PE ratio and the fact that it's going to decline most likely and get somewhere back to its mean, in the future. So let's summarize what we spoke about today. The economy appears to be in good shape, both in the United States and around the world. We continue to grow on a slow and steady path here in the U.S. in the 2% area. Markets rallied after the election on anticipation of higher earnings, but also the pro-business side of the Trump agenda. However, it's become apparent in the last few weeks that that agenda is not going to be enacted so quickly. So the market is rethinking what they call the reflation theme, and that has gone by the wayside for the time being. Markets have pulled back in the last couple of weeks. We might be at the beginning of a correction, which is probably long overdue. However, we do not see a recession in the near term, so therefore we don't think there will be a pullback that's normally associated with bear markets. We think it would be a more moderate pullback in the 5 to 10% range. Of course, we have no way of knowing, and there are no guarantees on that, but that's just what our thoughts are based on the current economic environment. And of course, we can't account for things we don't know about, like possible geopolitical or terrorist kind of events in the future. As interest rates begin to increase in the future, that will push down the price to earnings ratio, which will lower the value of the stock market. Now, offsetting that will be increases in earnings. So how the earnings increase and how the PE ratio declines, that really will determine what future returns are in equity markets. We closed with this slide at the last webinar, and we're going to close with it again. We think this is an important slide. It's important to remember the big picture. Over time, as you can tell on this graph, equities go up, but they also go down. But if you look at long periods of history, the trend has always been up. Anyway, thank you very much for listening. It's important that you read our weekly newsletter to stay up to date on things that happen in between the different webinars. If you have any questions or comments, please get back to us. Contact myself or Amari or Robert at the office. Have a great day, and thanks for listening.